financial crash in 2000. Now, new data out this morning from the Office for National Statistics has revealed how the cost of living crisis is impacting businesses. It shows the number of company insolvencies has reached its highest level since the aftermath of the financial crash in 2009. Well, I'm joined now by the business expert, Gemma Godfrey, to break it all down for us. Hello again to you, Gemma. Now, it's not sounding great already for so many businesses. Insolvencies, liquidations, what are we talking about here and just how significant is it?
Well, the breaking news was talking about insolvent companies, which are companies that can't afford to pay back the money they owe. But we also have companies that are liquidating, which are already selling off their assets to be able to pay back these debts that they owe. And if we look at this chart, which actually combines those two numbers, what we can see there is if you go all the way over there, is actually there are more companies that are shutting down their operations than we saw at the peak of the financial crisis. This is how serious it is. We actually saw it basically during COVID when the government came out and gave companies a bit of financial support, it temporarily went down, but we're seeing it all feed through now. And if we look at what's causing that, it's unsurprising that it's being caused by energy bills. So what this shows is that businesses that are still operating are expecting that when they go to fix their energy costs again, they're going to be seeing an increase in their electricity bills by either 2 times, 4 times, and this is 50% of companies, and another quarter of companies think they're going to see a 4-fold increase in their energy costs, which means that there's likely to be more companies going insolvent and bankrupt, which means that we could potentially see job losses. And in how it's going to impact us immediately, if we look at the red areas here, is that this shows us that over half of the companies actually haven't yet passed on the cost to consumers. And in particular, where we're going to feel this is in arts and entertainment. So things like cinema tickets will be going up in price, or theatre tickets as well.
And that leads me on to my next question, which is, how is this going to impact consumers? Prices have increased already. And is this going to get a whole lot worse?
Absolutely. And the challenge is that we've seen certain price increases for consumers, but a lot of businesses haven't wanted to pass on prices. Because if we look at the next chart, what this shows us is the difference between the money we're spending and the value we're getting. So the red line shows us the money we're spending. The blue line shows the amount that we're buying for that amount that we're spending. And what you can see is for the first time since COVID, since the pandemic, we're now spending more money and getting less value for it. And what's most concerned, if you look at the blue line, is it's starting to dip down into negative territory below the 100 line, which means that we're actually starting to buy less. And that will obviously feed back into companies, selling less goods, which will mean that more of them will be going insolvent. And where we are actually holding back on where we're spending is we're still spending on essential goods, which is the blue area there, but we're really delaying a lot of unnecessary spend. So you break your phone, you're not necessarily going to go out and replace it or buying new clothes. But the concern is once you've delayed as much as you can, people might fall into debt in order to pay for their essential goods.
And we're already hearing about that, Gemma.
It's the stage to go from 75 to 50 to 25. Rick Rieder and I spoke about this moments ago. Is that sufficiently good enough for you to add to equity exposure?
No, Jonathan, I don't think so. I think it might be sufficient to create some sort of short-term bounce back, and that's what we've seen play out in the markets this year. But the reality is this is the Fed that is heading into a restrictive territory, and the markets need to account for 2 factors. First of all, we're going to have depressed valuations. There's no reason for that multiple to expand, so that can't be the driver of equity returns when the Fed is clearly holding rates in restrictive territory. The other thing that's going to happen, we are already, this economy is sort of on the verge, on the brink, and as rates rise across the board, there's going to be more slowness and potential for a recession. So the markets will have to price that in, and that means the EPS downgrades are likely still to come. So even if we get some sort of a pop because of a so-called Fed pivot, the reality is the relative value of equities is quite challenged when rates are close.
All right, so we're coming in at 263,000 non-farm jobs, 263,000. The estimate was for 250. This is a little bit stronger than expected. And there goes the market, and that's the Fed story. Let's get to the unemployment rate. That coming in weaker than expected, 3.5%. Remember, we were at 3.7% last month. Expectations, we were actually going to stay at 3.7. We are now at 3.5 right now. That is, again, the unemployment rate. Let's go through and look at some of the other numbers that have crossed in here. Goods producing jobs, 44,000. Government jobs, a loss of government jobs of 25,000. 22,000. Average hourly earnings, 0.3%, a gain of 0.3% for average hourly earnings. The U6 rate, 6.7% on the U6 rate. That is, we were 7% last month. Now we're at excuse me, what I just said. Let's go through and go to some of the other factory jobs, 22,000. Again, factory jobs coming in at 22,000, a loss of government jobs. Remember, we gained 40,000 jobs last month in the government sector, and now we just lost 25,000. That's pretty darn interesting. Labor force participation rate, 62.3%. 62.3%. Charles, I know that you were looking for that, and that is pretty much in line with what we had last month, a 62.4%. So again, the average hourly work week, 34 and a half hours, and that's actually in line with what we were expecting. Again, going through this, 263,000 jobs. The expectation was we were going to have 250,000, and that is, but I got to point out here, that's weaker than what we had last month. Remember, we gained 315,000 non-farm jobs last month. Now we're at 263. So even though we beat expectations, you are seeing that number actually change just a little bit. As for manufacturing payrolls, again, as I mentioned earlier, 19,000 manufacturing jobs. Private payrolls, which is different from non-farm, that came in at 288. Private payroll. So that came in hotter than expected. As far as average earnings year over year, pretty much in line, 5% jump year over year for average earnings year over year. And again, I gave you that work week and the labor force participation rate again coming in at 6.
The world cannot afford to delay or lower our ambitions. The current challenges are urgent. And that is why I, along with leaders from a broad group of countries, will be calling on World Bank management at the annual meetings next week to work with shareholders to develop a World Bank evolution roadmap by December. Deeper work should begin by the spring. Shareholders will then need to drive parallel, holistic reform efforts across other development banks as well. To accelerate this work, my team will step up our engagement with World Bank shareholders and management, and we look forward to discussing more details on this project in the coming weeks.
So Tobias, how do you assess global financial stability currently with very high and persistent inflation and, of course, asset price volatility?
Yeah, thanks so much, Randa, and it's great to see you all here in person. Global financial stability risks have increased with a balance of risk that is skewed to the downside. Amid highest inflation in decades and extraordinary uncertainty, markets have been extremely volatile. Risk assets such as equities and corporate bonds have declined sharply. A deterioration in market liquidity has amplified price moves, and financial conditions have tightened globally. In many advanced economies, financial conditions are now tight by historical standards. In some emerging markets, they have reached levels last seen during the height of the COVID-19 crisis. With conditions worsening in recent weeks, key gauges of systemic risk, such as higher dollar funding costs and counterparty spreads, have risen. There's a risk of disorderly tightening in financial conditions that may interact with pre-existing vulnerabilities. Investors may further reassess the outlook if inflationary pressures do not abate as quickly as currently anticipated, or if the economic slowdown intensifies.
To the question of whether crypto truly is risky within the traditional banking system and the connectivity, because there was a major announcement this morning, which is that Bank of New York Mellon, which is, I believe, the largest bank in the United States by assets, has officially now entered Bitcoin custody. And the interesting question that is raised by that is that they are a bank holding company that is regulated by supervised by the Federal Reserve. My company, as you know, has a lawsuit against the Federal Reserve, and I am about to make some news. You will see a filing from my company in that lawsuit pertaining to the announcement this morning, because the Federal Reserve filed filings last week talking about the risk to the financial system from crypto, And then today, a Federal Reserve supervised bank holding company enters crypto. We've been waiting for 2.5 years to do that. And look what the Fed actually said last week versus what it did today.
Well, no one's ever accused DC FinTech Week of having too many shy people.
What a pleasure it is to be with you to open this Cybers 2022. Our theme, Progressive Finance for a Changing World, could not be more timely. The rise of inclusive finance is a genuine good news story at a moment of great challenges. Over the last decade, a quarter of the world's adult population has gained access to financial services. Fully 76% of adults are now in some way included. This is a remarkable achievement, which has unlocked new opportunities for millions of people previously left behind. Investments in critical digital public infrastructure, such as greater connectivity and digital IDs, have laid the foundation for this amazing growth. And the rise of digital payments has driven a massive increase in account ownership. In the last 4 years, almost 40% of adults in developing economies opened their first account to receive a wage or a government payment. Millions of small merchants are now paid or making payments with their own phones in their own pockets, transforming their ability to manage their finances and invest in their businesses. This, in turn, has enabled financial service providers, especially new fintech players, to innovate in the design and delivery of new products and services. The rapid growth in mobile phone use and new customer data trails offer exciting new ways to deliver financial products by leveraging big data and AI, especially in emerging markets. Yet, we should not seek innovation for innovation's sake. With each new technology, such as central bank digital currencies, for example, we must always ask, what problems are we trying to solve? And what future are we envisioning to stand the best chance at achieving long-term success? How do we provide more value beyond what existing platforms can already deliver? Well, the first priority is to make sure we do no harm. Ensuring key digital public goods are in place, like cybersecurity, consumer protection, data governance, and digital literacy, can help marginalized communities navigate financial services more safely and in ways that really work for them. Fair competition and interoperable payment systems can help markets work better for even the smaller scale customers. But that is only a first step. We have a chance today to move beyond doing no harm to actually doing good. So beyond transaction volume and customer acquisition, can we create the rails for transformative change to help users become more financially healthy? Just as we should not innovate for innovation's sake, we should not design products simply to maximize short-term results. Rather, it is important to see how much value we can generate in the long run. Value for customers that in turn translates into value for firms. For example, one Australian bank invested in measuring financial well-being of their customers to understand their behaviors and to develop products that could help them become more financially healthy. This resulted in a gold tracker program that helped 20% of their non-savers to start saving regularly. How can we do more of this? How can we help people to better manage their day-to-day finances, to get access to credit, to plan and meet future goals, and at a time of multiple crises, to build resilience and ensure themselves against shocks? To do so makes real good business sense. Financially healthy customers are better customers. And those who provide these services can differentiate themselves from other providers. But for the moment, that is not what is happening. Today, despite growth in account ownership, only 55% of adults in developing economies can access emergency money within 30 days. 55%. And almost half of respondents in a recent survey, including those from OECD countries, therefore rich countries, agreed with the statement, "I have no money left at the end of the month." In some places, we have seen both an increase in access to finance and simultaneously a decrease in financial health. So please, let us identify the best solutions to these challenges and really bring them to scale. One approach is to encourage private-private partnerships that provide services across entire value chains. In Côte d'Ivoire, for example, I saw an excellent partnership between an agri-tech platform, WeAgri, and a company that processes and distributes cashew nuts and a financial sector provider. Together, they were able to combine financial services, market access, business training, and extension services to help women across Côte d'Ivoire's cashew nut sector. This partnership has benefited everyone across the value chain, and it has increased efficiency, transparency, and productivity, supporting local economic development. Collaboration across industry and government is also key to creating inclusive digital public infrastructure that really enables services beyond finance. Think about health, think about education. These are the building blocks of sustainable development. If we get this right, digital innovation holds tremendous promise for financial inclusion and financial health. So let us please envision that better future, share our experiences, and use this conference, ladies and gentlemen, to build a secure, trusted, and efficient digital economy that really works for all. I really trust that you will actually take it to the next level and you can make a difference in your own countries. Thank you so much.